Okay, good evening, class, and welcome to MI class for today. Okay, let me begin by sharing my notes with you. Okay, if you can remember clearly, the last time we were on topic number 8, we did costing method, job costing. We were doing job costing until we ended the class. So we are going to start, look at batch costing, then service costing. Then if there is time, we may want to go to what we call process costing. And I'll tell you that process costing is not something we can finish in a class. Okay, we looked at job costing, and we said that job costing is like relevant costing. It's also like contract costing because it is specialized. It is specialized for the customer. The customer is asking for a special job to be done for him or her. And we said that each job is a unit. So you are not doing several units for the customer. You are just doing one job representing all the things that the customer will require from you. And so we looked at the job cost, how to get a total job cost. We'll add all the direct materials, direct labor, direct expenses. And we said those direct expenses are the expenses that relates to the job itself, specific to the job itself, that without those expenses, the job may not really be done. Then we also have what we call production overhead. And we said we'll be using what we call the overhead absorption method, which is absorption costing to absorb production overhead. We talked about it. We said it can also be a percentage of labor costs. We also talked about non-production overheads, which could also be percentage of labor cost or prime cost. We talked about them. We now saw an example of what I was just saying, non-production overhead. You see it here, 40% of prime costs. So we say it can be like that. Then production overhead, you see it's at labor costs. Okay, we now talked about job cost account. What we call a job cost account, we had a job here, and we saw that the direct materials were debited to the job account, the direct wages and expenses, if there is, were debited, and even the production overhead was debited. If there is going to be non-production overhead, you will see it here. Then the sum gives you your cost of sales. So everything here is transferred to the cost of sales account. We now saw an example of 3 jobs. One of them was not completed. And we said the ones that was not completed does not have cost of sales. It's still having a work in progress. We saw how we use that account to show how we can prepare resources used in the month. We also saw how we can prepare utilization account for entries for account for utilization. So let me show you again how it was done. Okay, so we saw here that in the resources used for the month, all the jobs used material X, and we saw the quantity used and the cost. Material Y, only 2 of the jobs used it and their cost. We saw labor grade A, how it was used, and labor grade B, variable overhead, fixed overhead. All these are the resources used in the job. We saw how we put the entries here, the material X entry, debit and credit, the journal entries, all those resources had journal entries. We saw how it was entered. Then we had the job cost account, how each job name, each job number is a separate account. The balance brought forward from last month. Then we saw how material X and Y were issued, how labor grade A and B were applied, variable overhead, fixed overhead, everything transferred to cost of sales, each individual job. Now, the one that was not completed was not transferred to cost of sales. It is still carried down to be continued in the next month. So the ones that was completed was taken to cost of sales. Then we saw the cost card. The one that was not completed, it was just ending at factory cost here. Even though we had the contract price for it, since it has not gotten to cost of sale, we will not know whether we made a profit. But in these ones that was completed, we can see that there was profit. Then we had the work in progress control account. We saw that the work in progress control account had the balance carried forward from last month. Look at the inventory for all of them, inventory control. Then look at the inventory control, the ones that was returned. Yes. Then look at the payroll control, which is for the labor. Then this is the variable overhead, fixed overhead, higher cost. Then these ones, this cost of sales happen to be the completed jobs. Then the balance carried down is the one that was not completed. So we got to see work in progress. Then we see all of these, the control accounts, the cost of sales accounts, the fixed production overhead, all these are demanded. Now let's go to batch costing. Now batch costing begins our lecture for today. The nature of batch production. As the name suggests, batch costing is a system of costing for items that are produced in batches rather than individually. Now, you see, most of our production runs are normally done in batches. Okay, when you go to get maybe medicine, you will see the right batch number. Sometimes you see when you want to check for NAFDAC number for some products, you will see product number, you will see batch number. So it means that if a particular product is seen to be bad, they can trace the batch and say, okay, everything in this batch, let's see whether these things that is produced in this batch, whether they had issues. So you see a batch is what some productions go through. They go through batches. But you know, job costing cannot be going through batches because you are not doing repetitive work. But when you are doing repetitive work, you can do what they call batch costing. When we did absorption costing, you saw batch size, batch. So you see that production goes through batches. Now, a batch might be called a production run. Batch costing is used when production are manufactured in batches or production run. I normally call batch. I used to make my listeners understand. I used to call it carton. I used to call it crate. So when you say a crate of egg could be a batch of egg. A crate of Indomie, a crate of mineral could be a batch. It could also be called a container. So one container load of could be a batch. So now I want to extend it further that when you are doing production, from the time you start and end a set. So when you say a set is a batch, so sometimes you might start a set and after maybe 2 hours, that set is finished. You finished a batch, then you start another batch, things like that. Now, batch production is used in manufacturing in the following circumstances. Now, the first circumstances is the capacity of a factory to make a product exceeds the sales demand for the product. So the factory is therefore not required to make the product continuously. Instead, it makes the product in occasional production runs or batches. So you see, when the production capacity, when the production capacity exceeds the sales demand, so what they will do, they will produce in batches. Now the factory makes several different products using the same equipment or machinery. The machinery must therefore switch between making the different products. So, which means that the products will not be manufactured continuously. So, the opposite of batch production is continuous production. Continuous production can be achieved when you are doing just one type of product, or you are using one type of product going through the machine. But now when you are using different products going through a particular machine, so you see, you'll not be making product A continuously. At some point in time, you have to stop product A to do product B on the machine. So the time the product A was running through the machine is a production run. That is a batch. Okay. In some industries, it might be impractical to manufacture items except by making them several units at a time in batches. For example, an example is the manufacture of bread, rolls, and other products in a bakery. So you have to produce bread in batches. Bread is an example of what they produce in batches. You cannot produce just a single bread. You are just going to be wasting resources. So how do they produce in batches? You know, the oven, they know how many the oven can carry. And so they might decide that a batch could be how many the oven could carry. All right. Now, the nature of batch costing. In batch costing, the total cost is established for each individual batch, where each batch consists of a large number of similar units or items. Now, unlike job costing, however, it is less common to include non-production overhead costs within the total batch cost. But it is possible we can do that. Now, to establish the cost per unit, the total batch cost is divided by the number of units produced in the batch. So if you want to get the cost per unit, all you need to do is get the total cost for making the batch. Then you divide the total cost for making the batch by the number of units in the batch. That is the way to get your production cost per unit. Let's look at an example. Look at batch number 1, 2, 3. So you see, this is a batch costing. You see batch number 1, 2, 3. We have direct materials. All the materials used in producing that batch cost 55,000 naira. All the labor applied, when we use our timesheet and all that, labor cost is 30,000 naira. Now look at the production overhead absorbed. It could be absorbed using production labor hours. So you see, this is 75,000. When you now add them up together, you have 160,000. That is the total cost for producing that batch. Now, how many units make up that one batch? 2,000 units. So when you say 160, you say 160,000 divided by 2,000 naira. Divided by 2,000, it gives you 80 naira per unit. So that's the way to get your unit cost, because your batch cost here is 160 per batch. So you've gotten your 160 per batch, but per unit is 180. So this 80 naira is important to get per unit. This 160 is important to get per batch. We use them to plan. So to prepare for the next production batch or production run, the next batch, there might be setup costs. So if there are setup costs, these can be charged to the batch that you want to do. So that's how we do our batch costing. Now, cost records and account for batch costing. Here we find that in job costing, it is necessary to record direct cost of each job. In the same way, in a system of batch costing, there must be a system for charging cost directly to individual batch. So you see, that's why we need to get our total production cost per batch, not just only per unit. Okay, each batch or production run should be given a unique identity code. So we see batch number 1, 2, 3. That's an identity code for that batch. So you'll be surprised, a job would be job number 1, 2, 3. That's for job costing. Batch could be batch number 1, 2, 3. So there must be a unique code for the batch. So how will you differentiate a code for job and a code for batch? If I use the word batch 1, 2, 3 or code job 1, 2, 3, that shows you are linking them to job or to batch. When direct materials are issued from the store, the material requisition note should specify the batch to which the materials will be used. So you see, just like job costing that you specify the job you are using it, this is specifying the batch you are using it. Now, direct labors, time spent on each production run or batch can be recorded on timesheets within production cost center. So you see, everything we did in job costing is the same we will do in batch, but it's just that the difference is this is for job, 1 unit, this is for batch, similar items making up a batch. And we can now find how much it is for just one. Sometimes the number of batches may be constant at a particular unit, number of units. Sometimes it may not be constant. So there may be, if it is constant, then fine. You can use the batch production cost to plan. You can also use the per unit cost to plan. But if it is not constant, then you may have to do this work for every batch that you do. And that's for batch costing, which is similar to job costing. Now let's go to service costing. Service costing. Now, the nature of services and operation. You know, sometimes in business, you do not have goods and services you produce, but rather you produce services. So it is usual to explain costing in terms of how to calculate and record the cost of manufactured products. Yes, but many businesses provide services. For example, FCA provide services. We do not have a physical goods which we sell. We provide services. So services are any activity carried out by a party to the benefit of another that is essentially intangible and does not result in the ownership of anything. So we are giving you an intangible service. This lecture is an intangible thing and nobody owns anything. So when you get that knowledge, you have the knowledge. I am not the owner anymore. Examples include hotel services, consultancy services, legal and accounting services, telecommunication, TV and radio, postal services, entertainment services, medical services, educational services. Now, there are some characteristics of services that we want to find out. Okay, the first one is intangibility. Intangibility. They do not have physical substance, and so you cannot touch it or you cannot see it. So you see that you cannot touch my lectures. You cannot touch MI that I am giving you. So it's not a good service. Then there is what they call inseparability. So the consumption and creation of a service cannot be separated. It's unlike goods that you can create goods separately and keep it in shop and in store and be waiting for who to come and buy. But in service, as the goods are created, as the service is created, it is being consumed at the same time. So like right now, the service has been created. As I'm teaching you now, I'm creating that service and you are consuming it at the same time. But you know, if it were to be a video lecture that I would have talked and saved it in the video lecture, so I have created a service. Now when you buy that video lecture, so that's why that's goods. You've bought a good and now that you are consuming it. But if it is a service I am doing it right on the spot. And as I'm doing it, you are consuming it right at the spot. Variability. Services face the problem of maintaining consistency in the standard of output. So goods are usually supplied to it. Now, if you look at goods are usually supplied to a standard. Wow, the student have gone off. So let me hold on a moment. Let me hold on a moment. The student say he can't hear me. I think he may need to restart his system. Okay, so now we're talking about service. We said service have some characteristics here. There are 5 in number here. Okay, 5 in number. There is the intangibility. This intangibility is you cannot see them, you cannot feel them, and so they are not tangible. You cannot see the lecture I am giving you, you can only sense it. Okay, then we talk about inseparability. You cannot separate consumption with the creation of the service. As I'm creating the service, simultaneously you are consuming it. So it's not like goods that you create separately and you look for who to consume. So as it's created, it's consumed. It is not being saved. Now, okay, we have variability. That means the service is not done to specification. So the goods are done to a specified standard. So you see, if you want to produce bread, they will tell you, okay, do it to maybe 0. Maybe 0.1 kg, fine, or 0.2 kg, that's fine. It's a specific standard. They will tell you that something is substandard. That means they have a specific standard. But in the case of service, you cannot expect every service you see to be exactly the same. Exactly the same. So for example, if I'm teaching this topic to a group of people who have who are in physical class, it may be different from the way I'm teaching you now. It's the same topic. It may be different from somebody who I'm teaching revision. It may also be different from somebody who is just hearing it for the first time. But this is just one thing, the same thing being given out in different ways. We talk about the perishability of the goods. So the goods, of the service. Services cannot be stored. It's either you accept it now or you reject it. So, when somebody go to get some services like education services, and it's either what they are teaching you makes sense and you accept it, or you think that they are teaching you nonsense and you reject it. And so some people, when they carry nonsense, they go about with nonsense because you cannot save the product. It is what you get and you accept. That is how it is. So services get perished. So in case you missed out on something I was telling you, maybe an example or illustration during that time that you say you cannot hear me and I cannot know what you have missed, that service would have been perished because it cannot be stored. Although, of course, if it is in the form of goods, if it is in the form of CD, you can go back and go and see it. So you see, goods, it can be stored. It's not perishing. But in the case of service, as I've created the service, you've consumed it, it's perished. Now, lack of ownership. So there is no transfer of property in anything. So the service is only just being rendered. There is no property transfer of anything. For example, I cannot claim to be the owner of this knowledge, that I am having the ownership right of this knowledge. I have known it. I have transferred it to you. When I have taught you, I have not transferred the property right to you. So there is nothing like ownership of the service. Now look at operations. Operations are activities. Like services, they do not result in a finished product to sell to customers. Examples of operations include a customer service center taking telephone calls and emails from customers, and the staff canteen providing meals to employees. So the activity that people do is called operation. So for example, in FCA, our operation is to teach. Now we are teaching using Zoom. So that operation is what we leverage on to provide those services for you. Cost unit in service costing, we have composite cost units. One of the main problems with service costing is that it can be difficult to identify a suitable cost unit for the service. It is often appropriate to use a composite cost unit in cost service. So you see, it is not easy to give you how much a service will cost because, it has to be tailored to your own need. It has to be tailored. So yes, it is the same service, but there may be some variations, and those variations is what will make them different. So a composite cost is a cost that is made up of two variables, such as a cost per man per day. That's an example. So now look at an example of composite cost here. Cost units used in servicing cost are as follows. Now we have the cost per room per day. This is one example of the composite cost. So this is a useful unit cost in the hotel service. Now we have another one here, the cost per passenger mile or cost per passenger kilometer. So the average cost of taking a passenger to a particular kilometer. In Nigeria, we don't practice that. We only know that when you are going to a particular bus stop, let's say you are going from Ikorodu to TBS, you know that you know the costs. Or if you are going from Ikorodu to Fadeyi, you know that there's a particular cost. I don't know if they have measured it in kilometer beforehand or so, but really, we in Nigeria do not practice this type. Okay, so all these are examples of composite cost. Now, let's look at calculating the cost per unit of services or operations. Look at the formula here. The cost per unit of a service is the total cost of the service divided by the total number of units of service. So let's look at an example here. Example says a hotel has 80 standard twin-bedded rooms. So there are 80 rooms here. The hotel is fully occupied for each of the 350 days in each year it is open. So in every day, these 80 rooms is occupied. The total cost of running the hotel each year is 3,360,000. So the question is, what would be a useful measure of the cost of providing the hotel services? So what would be a useful measure? The useful measure is unit cost. Is the cost per room per day. The cost per room per day. So let's see, they say this is the average cost of maintaining one room in a day. So you see that the rooms per day, we have 80 rooms in one day. That's fine. It's as good as saying you have produced 80 goods per day. Now, there are 350 days. That means we will have 28,000 bookings. That is what it means now. 28,000. It's not that there is 28,000 rooms. These 80 rooms has become 28,000 rooms in the whole 350 days. So you book one room a day, one room a day. It means that you are booking 28,000 rooms in the 350 days that the hotel is running. Now we see that to maintain the hotel in a year is going to be 3,360,000. Now divide it by 28,000. It means that if we charge 120 naira per day for a room, that is the minimum cost for the service. So you see, if we were to charge 120 a day, we will get this amount in the year that will be enough to run the rooms. So this represents the minimum that the service can charge. Now look at another example here. A train company operates a service between two cities, South Town and North Town. The distance between the cities is 400 miles. 400 miles. During the previous year, the company transported 20,000 passengers. So now they are relying on the previous year to make a forecast for what they will do the next year. All right, from here down to here. And they also carried 175,000 passengers when they are returning back. The total cost of operating the services were 60 million. Now we are asking, what would be a useful measure of the cost providing the train service between the two cities. Now you see that we are going to use how much it costs to provide the service. The cost of operating the service is 60 million. That's good. Now, the passengers are going from south to north is 200,000 passengers. And look at the number of miles that they go, 400 miles. The same miles did not change. Then coming back, the same mileage, 175 return journey. So when you multiply by mile, everything is 150 million. 150 million. That is the passenger per mile in a year. That means if you use the 150 million to divide the 60 million, it means that this is the amount they should charge per mile. This is the minimum amount they can charge per mile. So that's it. Now let's look at the summary for today. We've seen the nature of job costing. We've seen how we can calculate job cost from a given data. We did that on Monday. Saw the nature of batch costing. And I told you that batch is kind of different from production job costing because you are having similar items being produced at the same time, while in job costing, only one item is made specifically for the customer's need. Then we talk about service. Service, there is no job, there is no batch. You are not producing anything, but you are rendering service. So we saw the characteristics of service and how to calculate service. So that's the end of this topic: batch costing, job costing, and service costing. I will advise that you go and look at past question papers that contain them. Then you get something like this. Each of the questions, if it is a multiple choice question, you look at the diet and you answer them, you tick them, you answer them, you tick them. This is for the 20 multiple choice questions. You tick them anywhere you see the batch costing or job costing question. Then you go to the essay type of question. The essay type of question, you check the level, the diet, and look at the question number, you answer, you tick. So that way you are keeping track of each topic we've given you. Go to past question, keep track of the past question that handles that topic. Okay, for the next 1 hour, we are going to be looking at another topic. This topic here is called process costing. Process costing. Okay. So let's look at process costing. Now, this is part 1. Obviously, even this part 1, we may not finish it today. So part 1 will extend to the next class, and we'll finish the whole of process costing by next week. We are going to be explaining process costing. We're going to explain when process costing is appropriate. Then most of the things we are going to be doing is to prepare process accounts. We'll be looking at different situations when there is normal loss, when there is abnormal loss, when there is abnormal gain. These are the parts that is contained in part 1. In part 2, we'll be looking at process costing with work in progress, opening work in progress. We look at weighted average method, we look at the FIFO method, we look at work in progress and losses, process costing, joint product, and byproducts. That will be the end of process costing. So this is one key cost, one key topic that you should not play with. It's very, very, very important. Process costing provides a system of costing where any of these characteristics occur. Now, one, output is continually produced from the manufacturing process and is normally measured in total quantities, such as stones or liters produced, or in a very large quantities of small units. You will get what they call process costing. Now, notice here that process costing is for goods and is for goods, not for service. It's only applicable to goods. In the production process, materials might be added in full at the start of a process, or you might be adding material gradually throughout the process. The material are processed to produce the final output. Now, in a process costing system, it is usual to distinguish between direct material and what we call conversion costs. Conversion costs are direct labor cost and the production overhead. So direct material sitting on its own, then labor and production overhead are called conversion costs. So you may not really be seeing labor costs, production overhead. You may be seeing conversion costs. So just know that when you see that, it refers to these things. Now, one thing you'll be seeing in process costing is that there will be losses. There might be losses in the process due to evaporation or chemical reaction. Okay, let's say, for example, I give you a bucket of water, or maybe a jug of water full, 1 liter, to go and boil. When you boil it and it is boiling, and you bring it out, you leave it to cool, you pour it and measure it again, it's going to be less than 1 liter. So that means there have been losses in the process. So there will be loss in the process. Another one is gas. When you are doing gas, you experience loss in process. Okay, we'll be looking at them. Process costing provides a system of costing that allow for these expected losses. When there is a continuous production process, it is difficult to measure the quantity of work in progress, which we call incomplete production at the end of a financial period. And so in process costing, we look for a method of measuring and costing the incomplete work in progress. So, in the end of the financial year, you want to give a report on how much is your quantity, your materials, and your material consists of raw material, finished products, and work in progress. Of course, you can measure the quantity. You can measure the quantity and value of raw material. You can measure the quantity and finished products. But when it comes to work in progress, you find it difficult to measure. So, but there is something that we do in process costing that will help us out, which you'll get to find perhaps in part 2. In some processes, more than one product might be output from the same process. For example, crude oil. When you try to refine crude oil, more than one product. We have the spirit, we have the kerosene, we have the diesel. These are 3 products that could be produced. When more than one product is the output, they might be called a joint product or a byproduct. So you see, sometimes we hear petroleum byproducts. Okay, you'll be seeing that in process costing. In some process manufacturing system, there is a series of sequential processes. Yes, there is a series of sequential processes. There is going to be process 1, process 2, process 3. Now let me give you an example of bread manufacturing company. I'll use that a lot. Now, there are different processes that occur in the bread factory. Now, the people who start the production, I'll call them process 1 department, which is called the millers. They will start with the raw material. That is their input. The input is their raw material. They will now put all the raw materials together, mix them together. Okay, that's the mixers, yeah? They will mix them together. Mix, 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 mix. When it is finished, the end product is their output. It's a mixed material. Now that mixed material becomes the input for the next people who are the millers. They will mill it, they will knead it, and put it, and they will start cutting it and put them in scales to measure. When they put them in scales to measure, they put them in the pan, and they keep the pan to rise. That's the output of their own products. It becomes the input for those who wants to bake the product. So the bakers will take that bread that is being left to rise, put it in the oven. After some time, they bring it out. Now, when they bring it out, they put it in the shelf to dry, or to soften and to dry, to be cold, the cold room. So that's their output, a baked bread left on the shelf. That's process 3. The slicers will come and they will go to that shelf and take the bread. So that becomes their input, and they slice and put it in the nylon bag or the leather or anything that they use to finally case it. So that becomes the final product. Final product. It is when it is being put in the label, the bread, the wrapper. That is when it becomes a final product. So as long as it is still lying in the shelf unsliced, if it's a company that is selling only sliced bread, it is not a final product. So you see, the process goes from one to the other. The output of one process becomes the natural input for the next process. It's just like people running a relay. If there are 4x4 relay, as soon as the first man starts the race, he runs and gives the baton to another person. The person takes the baton, process 2 takes the baton, run, and get to process 3, gives the baton to process 3. Process 3 run and gives the baton to process 4. Process 4 runs and finish the race. That is how we are going to be understanding process costing. Situations where process costing might be appropriate. Process costing is used when output is produced in a continuous process system, and it is difficult to separate individual units of output, especially in bread. It's difficult to separate the individual output, so you must produce them continuously. Examples of manufacturing process where process costing is used is chemical manufacture of liquids, the continuous manufacture of high volume of low-cost foods, such as tin of peas or beans or bottle of tomato ketchup, and I've added bread. In this type of production process, losses in process might occur. Losses in process might occur. And there are often problems in measuring the exact amount of unfinished work in process at the end. So you see, we are talking about two things here: difficulty in measuring the unfinished work in process at the end of the financial year, and losses that you will incur. So what can you do about all of this? So we are going to look at the process costing issues here. Now let's look at process costing. Now you were given, look at what this place says. Process costing can be quite tricky at first. It is often helpful to draw a process account. So it's good to draw your process account because it will help you to focus your mind on the main issue, which is that costs are collected on the debit side. Costs are collected on the debit side of the account, and they must be allocated to whatever passes out of that account. So look at the first one here. You have, let's say, you have 100 units of materials, and it costs you 1,000 naira. The material cost is that. Conversion cost does not have units because you cannot be talking about units of labor. So you cannot be talking about units of production overhead. So it's only the material. That's what you should know. Only the material that should have units. The rest will just have naira. So you see, these 100 units of material, these are the costs here. So 100 units of material, it cost us 1,500. And now it has become an output. Maybe the final product, 100, still maintaining 100. Fine. So what you put in is what you put out, what you get out. Now you see there is no loss. Everything you put in was put out here. And you see the 1,005 is being allocated to it. So this is straightforward. This is straightforward. Now let's look at another. Now in the second one, we are adding a complication. This same debit side still gets the same amount of material and labor and conversion costs. But now you are seeing that 90 is coming out as normal output, and there is a loss of 10, and you are still having the same cost. Yes, it must be this cost. So the cost inputs are the same, but now there are two lines on the credit side of the account which we must allocate costs. So you see, there is a loss that is being made here. So we need to make a decision. Should some of the costs, this 1,005, should we allocate some of those costs to this loss, or should we allocate this whole 15 to the output? That is what we will be thinking about. Should we take the whole 90 be carrying 15, or should we share the cost between the loss and the output? Now let's look at another complication that we are going to add here. So you see now that the left-hand side is still the same, but now only 90 products out of the 100 was finished. Only 90 was finished, and only then 10 is still in process. Then we have 15. So now we must decide, how should we allocate this 15? How should we allocate it between output and work in progress? So you see, these are the two things that we are out to find answers to. When there is a loss, how do we apportion the cost between the normal output and the loss? When there is a work in progress, how do we allocate between the output and work in progress? We could also have a loss and also a work in progress and an output. So how do we allocate to all these three? Let's look at another example. So you see here, okay, there is an opening work in progress. So now this is from the last one here that have a closing work in progress here. From the new period, starts with the opening work in progress. There is the material cost, conversion cost is here. Then the output now becomes 95. then the closing work in progress is 115. So you see now that the cost has increased. So the opening work in progress is a cost that was input from the previous period. So you see, as you are taking over from one process to another or from one period to another, you carry the work in progress. So we still face the same basic problem. The total cost on the debit side have to be allocated to the output. However, the existence of work in progress means that we have a policy for dealing with work in progress. Okay, now let's look at this pro forma on how you do process costing. Now look at the formula, which is what you should learn. Now, just know that the opening work in progress will be here. Since it is still material, it will have elements of material in it. So you will have units here. But you know that work in progress will also have elements of conversion cost. But because it has elements of material, that's why it is having units here and the whole value is here. Then the direct material you are taking will have a unit and a naira value. Then your labor and your expense and your overhead, these three are separated here. You can see them separated, or you can join all of them to call them conversion costs. See them here, there is no unit. Then there's what they call abnormal gain. Abnormal gain. Now let me explain what sometimes looks like abnormal gain. Okay, have you ever, maybe you try to do some electronics work by yourself, you open a radio, you scatter the radio, or you open your computer, you scatter the whole computer, and you try to fix something, and you now couple it, and you didn't couple everything. There are certain things that were not inside, but the computer was still working as if you put everything. So you'll be thinking, how did this, what are the work of all these things that I didn't put them in the computer, but the computer is still working? That is the idea of abnormal gain. Now, it means that you put in, you're expecting maybe a bread, you put in material, this same amount of material, and you're expecting bread to come out 100 units, but you're seeing 110 units. That 10 that is extra is the abnormal gain. So abnormal gain is going to be here. So all you need to do here is your gains, abnormal gains are here, your losses are here. So let's go to the other side. We find out that your good outputs, there's a difference between good outputs and losses. These are good outputs. We call them good output because there is no defect in them. So what you got, what you put in here, you get them here. So this is the number of units that you got out, which is called good output, and their value. Then the loss that we expect, we call it normal loss. So let's say, for example, you are manufacturing bread, and you say that for every batch of, I'm using batch now, for every batch of 1,000 loaf of bread, you expect 5%, okay, you expect 0.1% normal loss. So you see, 1,000 loaf, you expect 10 to be lost, normal loss. Why do you expect normal loss? You mean that, it means that maybe inside when it is left to rise, something might happen. Maybe 1 or 2 might get spoiled or may not rise. They have issues. You put the remaining into the fire, 1 or 2 might get burnt. And You bring them out of the fire, one or two might get damaged by handling. And at the end, you're expecting all the complaint not to be more than 10. You're expecting a normal loss of 10. So that is it. Now, abnormal loss comes as a result of something you are not expecting. Now, abnormal loss could be maybe somebody come and steal it, okay? Or maybe we'll call it human rats came to come and eat. How many of it has this abnormal loss given you? So it is going to be stated here, the quantity and the amount. Then now I want you to know that this good output here is the same thing like this good output. So you can, what we are saying here, that you can have good output, normal loss, and abnormal loss, and work in progress. So this is just a portrayal whereby you can have normal loss situation and abnormal loss situation. Now, you cannot have abnormal loss and abnormal gain. Never. It's either you have abnormal loss or you have abnormal gain. Or you may not even have either of them. So you see, you have just good output and normal loss, or you have good output, abnormal loss. So it says here that it is not possible to have abnormal loss and gain on the same account in the same period. So look at the questions we need to ask ourselves. We need to look in all questions that you'll be asking exams, rather, you will need to identify the losses and the output. So losses, they say losses, you could have normal loss, you could have abnormal loss, and their output. What are the units? The units of losses. You have to calculate the cost of good output. So that's the value, and the value of the losses and the work in progress. Now use the costs you have calculated to assign values to the good output, losses, and work in progress, and you complete the process account. Okay, let's discuss something about normal loss. I've explained it before, but let's look at the explanation here. A feature of process manufacturing is that there is often loss or wastage in production, and output quantities are less than input quantities. So what you put in might be higher than what you are getting out. So that's losses. So losses could be normal, it could be abnormal. Normal losses are what you expect in the process. So look at the formula for normal losses. Normal losses equals to quantity of material input, what you put in, and what you are expecting out. For example, I put in 1,000 and I'm expecting 990. So the difference, which is 10, is the normal loss. Now, if you want to make quantity of input subject of formula, you mean that normal loss plus your expected output. So that is, in these three formulas, they have made each of these elements subject of formula, just in case you need to do with any of them. So normal loss is sometimes expressed as a percentage of the input units of the material. So we normally express it as percentage. When I give you bread as an example, I told you 10%, I mean 0.1%. Now look at example here. Normal loss of a process is 10%. If a company puts in 5,000 liters into the process, the normal loss is going to be 10% of 5,000, which means this is 500 that will be missing, that will be lost. What will be the expected output? Expected output is going to be 90%. 90% of 5,000, which is 4,500. If we are to use the formula, you can simply say 5,000 minus 500. From this formula here, you get 4,500. Now, normal losses are unavoidable in the course of the event. So since they are unavoidable costs, you cannot run away from it. So, you know, when we were learning relevant costs and non-relevant costs, we said avoidable costs are relevant, unavoidable costs are non-relevant. So because it is going to be unavoidable, you cannot escape it. So it's not used to make decisions. So you'll always be expecting a normal loss. Now look at another example. A person buys 1 liter of soup. The soup must be heated, but the heating will cause evaporation. When the soup is ready to eat, there will be less than 1 liter left. How much loss is how much evaporation would normally be expected? So when you're cooking and it gets evaporated, that evaporation is a normal loss. Now, there is what they call normal loss with no recovery value. Normal loss with no recovery value. Now, let's look at it now again. Going to that of the soup example. Now, assuming you buy 1 liter of soup for 500 naira, fine. And you went to heat it. And during the heating, 10% evaporated. Now, when the soup is ready, only 90% will be left, which is 0.9 liters of the food, of the soup that will be left, not 1 liter anymore. So since you have paid 500 naira for 1 liter, it therefore means that the 0.9 liters is carrying the whole cost of 500. And in this case, because the loss is unavoidable, So that shows you that you cannot add a recovery value for that loss. So you are not going to allocate any part of that 500 naira to this 10% loss. So the thing is that the whole 0.9 liters is bearing the 500 naira as what we purchase it. So this shows that the normal loss is something that is unavoidable in order for us to get good output. So the cost of the lost unit is part of the cost of obtaining the good output. So all the costs should be assigned to the good output. None should go to the loss. So all we now have is a nil value for the loss. So all we have is how many units were lost. Maybe let's say 0.1 liter. What is the value? Nil. All right, let's look at this formula. Cost of good output. It means the cost of good output is the total process cost. Those costs you get at the left-hand side divided by the expected unit of output. So, you know, it is the expected that you have to work with, because I said normal loss is unavoidable. Normal loss is unavoidable. So instead of working with the total units, you are going to be working with expected units. So the total process cost divided by the expected units of output, that will give you your cost of good output per unit. Now let's look at this example here. Let me make it so that you see all at once. Now, look at this example. Input quantities are 2,000 liters. We are expecting a normal loss of 10%. Therefore, the expected output will be 90% of 200. So when we look at it now in our calculator, 2000 multiplied by 0.9 is going to give us 1,800 liters. So 1,800 liters is your expected output. So this is what you are expecting to get out. Now, you now have actual output is 1,800 liters. Wow. So that means what you expected was what you got out. Now, direct material costs. So now what you expected was what you got out, that means there is no abnormal loss. That means it's only normal loss that you got out. Now look at your direct material cost. This direct material cost was a result of these 2,000 units or 2,000 liters. Look at the direct labor cost that was applied to it. Look at the overhead absorbed applied to it. Now look at what we are going to do now. The cost per unit can be calculated as follows. Your direct material, your direct labor, your production overhead. It gives you a total production cost of 4,500. Now, you're not going to use the 2,000 liters of input quantity. Your actual output now is 1,008. In fact, you're not even using actual output. You're using expected output, 1,800. And so it means that your cost per liter is 2.5. Naturally, if you had not gotten any loss, the 4.5 divided by 2,000 would have given you 2.25. But now, because there is a loss, that loss is being shared to all the remaining good ones. So it's increased the cost per liter. Now look at how the process account in the cost ledger will be like. The process cost account shown below is a work in progress account for the process. The debit side of the account records direct material and direct labor cost and production overhead, all the costs. Now the credit side of the work in progress account records the cost of the finished output. So the account also includes memorandum column for quantities of direct material input and quantity of the output and the loss. So the normal loss is shown so that the quantities column will add up. So you see in the process account, everything balances. So look at the process account now. We said the material was 2,000 units of liters, direct labor, nothing, direct production overhead. All of them we are working on the 2,000 units. And look at the process cost we have, 4,500. Now we want to allocate all of them at the other side. So you see, this 2,000 here must remain 2,000 here. 4,500 must remain 4,500. So, but what did we see? We see a situation whereby we have 1,800 actual outputs, which is equivalent to our expected outputs. And we mean that 200 were lost. We said this loss has no scrap or recovery value. So you see a nil value here. And so the whole 4,500 is going to this 1,008. So we said it is good to always draft a process costing at the start of an answer so that it will help you to focus your mind on what needs to be done. So that's it. Now, we've talked about normal loss with no scrap recovery, no recovery value. When we say no recovery value, it means there's nothing here. The whole total input cost is gotten by the good output. And now the good output, what he puts in is the liters is being shared between output and normal loss. Now let's look at the situation where we have a process cost with some scrap value. The normal loss quantity. Now let's give example now that in the case of a bread manufacturing company, some of the losses that you may expect might be bread rising too high, it's not too big or too small, or maybe you may see burnt bread. You will not have to sell it at the same price. You have to value it at a lower price. So you see, so there are some people who want to get this burnt bread for use for several things, use it to feed poultry and all that. Some people will still like over-rice bread. There's some people who likes it like that, and they will come and buy it at that price. So that's a recovery value for the loss. Let's look at it now. The normal loss quantity might not be physically lost, but is changed in some way, like what I just gave you, so that it is not the same as the good output. So you see, when bread is not the same shape, the same size, is too overgrown or too small, it's not a good output, it's part of your loss, but that loss can be recovered. All right. If normal loss has a scrap value, the company is able to recover some of the input cost to the process. The scrap value reduces the cost of the process. Now let's look at the formula. Cost of good output is the total process cost minus the scrap value of the normal loss divided by the total expected output. So the difference between this formula is, and that's former one, is just this recovery value here. So it's as good as this is the formula to use always. But in the first instance, your scrap value was 0. That's why it seems as if this did not exist. But now that it has some value, you see it's going to have value there. All right, let's see this same example again. The same example where we have 2,000 units, 10% normal loss, which is 200. Expected output is 1/8. And when I say your actual output is the same as expected output, it means that only normal loss has occurred. There is no abnormal loss. Now, the scrap value of normal loss, they give you, this is the scrap value of normal loss. Now, they give you direct material. They give you direct material is this amount here, 36. Direct labor is this. So the same thing. The only difference here is this 0.9 naira for 1 liter of loss. So look at what we are going to do now. The 4.5 is still the total production cost. Now, how many was lost? 200 units. 200 units or liters multiplied by 0.9 naira per liter will give you 180 naira. So 180 naira is the value for the scrap. So when you less it, this is what should be charged to the expected good output. So when you divide this by this, you have 2 naira 40 kobo as against 2 naira 50 kobo per unit that you had before. This is because you now have scrap value figure, which reduces the cost per unit. But when there was no value, the cost per unit increases because you see the units, because we have a loss. All right, let's see the process account, how it is being done. Like we did before, all our 2,000 units are here. The total cost is here. But now let's go to the output. I will suggest that when you are doing this, do this first, the left-hand side, bring this figure and this figure down here. Then do the normal loss first, this side. How many was the normal loss? 200. How many was the value? 180 naira. Then what you just do is 2,000 minus 200, you get 180. 45 minus 180, you get this figure. That's the best way to do it. So you've gotten your output. So you might decide that after you've done this, you can decide to use that too by multiplying your 1/8 by 2.4, you will get the same thing. But I would suggest you do your normal loss first. Let the output and the value be the balancing figure. Now we have normal loss with cost of disposal. Now, in other cases, a company may have to pay to dispose losses in a process. So not only are you having a loss, now this loss, you can see the loss. It is not the same thing as the good output, but you may need to dispose it. Let's say, for example, you are selling tomatoes or you're using it for your process, and the good tomatoes, you know, it comes out well. The other ones that are not well, you see them as loss, and you cannot use them. You have to dispose them, and you have to pay to dispose them. All right. So the process, the substance scrapped off the top of the liquid in the process might be poisonous, you see, might be toxic, and may have to be disposed for safety. So what do you do? So the cost of disposal represents additional cost to the process. So when you have to dispose, you are going to add it to the process. Now look at it again. It means the cost of good output. Look at the normal total process cost. Now you are going to dispose the losses. You add the cost to it. Now, in this case, there is no recovery value. There is no recovery value because you are not going to be paying to dispose it and be recovering something out of it. So you see, disposal costs and recovery costs are two opposites. So there is no recovery cost here. So now you see that it will now increase the cost per unit more. So look at example here, normal loss, no scrap disposal costs. Okay, look at it here now. The same thing we have been doing. 1/8 here is the output expected. Disposal cost of normal loss. That means you are spending 1 naira for every liter that was lost because it is toxic. If you keep them, it's going to be harmful. Now, you still have your 4,500 total production cost as before. How many were lost? 200 units were lost. How much are you going to spend on disposing the 200 units? 1 naira each. 200 naira will be spent on disposing. Now, the difference between this and recovery is because here you are recovering, so it's going to be lessen the total production cost. But now you are disposing, you are adding more cost, you are paying more money to dispose now. You are going to add them to get 4,700. This 4,700 will be shared among the expected output. So you see it has increased from 2.5 before when we had no recovery value to now 2.6111. Now look at the process cost now. You now see that everything remains the same 2,000 here, but the additional thing here is the disposal of normal loss. Disposal of normal loss is now 200. Now, you're not going to put the figure here. You're not going to put how many normal loss that you dispose, just the value. So everything you put in here was 2,000. Mind you, it is only the material cost. So the only thing you see here that has value of liters or units is material cost. The only thing again that you might see when we get to that point is abnormal gain. So this is things you will keep in mind. Material will have value in units. Abnormal gain, when we come to it, it will also have value in units. Then every other thing will have value in costs. Now this cost is what is being transferred. So what you do, you put this figure here, you do your normal loss first. How many was lost? 200 was lost. Did you recover anything? No. Put your dash. Instead of recovery, you have spent more money. So here I represent all the costs you made. So here I represent how much you're going to recover. This is your recovery cost, nil. So this is the balance, the balancing figure. The balancing figure for the 1,800 units. So it's going to take the whole 4,700. Now let's look at abnormal loss. Now, normal loss is expected loss in the process. Now, when actual loss might be more than expected, when the actual loss is more than expected, then there's what they call abnormal loss. It means that your actual quantity is going to be lower than your expected quantity. So it means that your loss has gone beyond normal. Look at the formula for abnormal loss. Now, abnormal loss is the actual loss minus expected normal loss. Now, look at from earlier, we have quantity of material inputs, which we say is our normal loss plus our expected outputs. We know that from previous formula. We now said expected outputs is equal to actual outputs plus abnormal loss. So you see, we are trying to use this kind of form. So therefore, quantity of material inputs will be normal loss plus actual outputs plus abnormal loss. So what it means is that all the quantities you put into your units in the left-hand side is going to give you three things at the right-hand side. One, you'll get your actual outputs. Second, you'll get your normal loss. Third, you'll get your abnormal loss. When you add them together, it should give you the quantity of inputs. So your total loss is going to be your normal loss plus your abnormal loss. So in case you're asking the question, what is your total loss? It's your normal loss plus your abnormal loss. So abnormal loss is not expected and should not happen. It therefore makes sense to give abnormal loss a cost. You know, unlike normal loss, which is expected and you may not recover it, abnormal loss is not expected. And so when it happens, it means that you have lost something and you have to give it a value. By giving abnormal loss, by giving a cost to abnormal loss, management information about the loss can be provided. And management can be made aware of the extent of any problem that might exist with the excessive loss in the process. So you see, when fire breaks into a place and people lost some documents, it's an abnormal loss. They don't expect anything to happen, but it just came in and you now experience it. So it is proper to give it a cost. So the same way in manufacturing process, that amount of bread that was stolen, which you are not expecting, that amount of bread that was eaten by insects or rats, which you were not expecting, is an abnormal loss, and it should be given a cost so that management will know the extent of that excessive loss. Accounting for abnormal loss. It is assumed that all losses in process occur at the end of the process. That's the first assumption. Units of abnormal loss are costed the same way as finished output. So it is assumed that the losses occur at the end of the process. That is it. So Dia says this might seem a little strange, but the idea is to highlight the impact of the loss. Yes, it might seem a little strange. Now, you are expecting a 10% loss of bread when you put it into the oven and you bring it out. You expect that 10% or maybe 1% will be burnt. And you're expecting the remaining 99.9% to come out good. And it came out, and due to some other things, another 0.1% of it got spoiled or became loss. You have to cost that abnormal loss the same way as the good cost, the good output. So that's the same formula you see here. Now let's look at this example. Example, abnormal loss. Now we are looking at the same situation, but can you see something here? Actual output is lower than expected. What does that mean? That there is 100 liters abnormal loss. Yes, of course, we've expected 200 liters normal loss, but we still expect a further loss of 100, which is abnormal. Now, the whole total cost is still 4,500. Yes, still 4,500. Now, the expected output, we said before, we are not using the actuals. We are using expected. So you see, when it comes to abnormal, there's nothing we can do. We have to think of the abnormal as inside the expected. So it is still giving us 2.5 naira per liter. So what it means is that we are going to use 2.5 to cost the normal, use 2.5 to cost the abnormal. So what do? We do the same way I told you to do it. Do the debit side first, the same way we normally do. Then go and do your normal loss. The first thing you should do is your normal loss. You put your normal loss 200, no value here. The rest is for your abnormal loss and actual output. So do your abnormal loss next. You can write all this as it is first, but putting values, put normal loss first, go to abnormal loss. How much is the abnormal loss? 100 naira. How much is the price for each good output? It's 2.5. Multiply, you get this. Then this becomes, the actual output becomes your balancing figure. Note that the abnormal loss is included in the credit side of the account in the same way that normal loss is shown on the credit side. Whereas normal loss has no value, abnormal loss has a cost value. It must always have a cost value. Now look at the double entry. Abnormal loss, you debit abnormal loss account, you credit the process account. So if you look at the process account, it's on the credit side. When you are going to put it in the abnormal loss account, you debit the other leg. So you see the abnormal loss account here now. The first one we did was the process X account. Now we are doing the abnormal loss account. So it's coming from process X like that. Now at the end of the financial period, the balance of the abnormal loss account is written off as a cost in the costing income statement. So this is abnormal loss written off, if it can be written off. So you write it off. but normal loss does not appear anywhere in your financial statement. Doesn't appear anywhere. Now, abnormal loss with recoverable value. Now, like when we have normal loss that was used to deduct, and you get a process cost that reduces the cost. Abnormal loss will have a scrap. When you have a scrap value, it is treated differently from the way we treat it with normal loss. Now, the cost of expected units of output is calculated the normal way we calculate it. Then the scrap value of loss, of normal loss, is the normal loss multiplied by the scrap value as we did normally. Now, in the process account, the cost of abnormal loss is measured at the cost of expected as we got before. Periodically, the units of the abnormal loss account are transferred to a scrap account at scrap value. The balance on abnormal loss is an expense for the period measured at the cost of the unit less the scrap value. Okay, let's just see some example. Now let's look at abnormal loss. Let's go to the figures. Abnormal loss. Again, we are given the same figures here, same figures like we did the first time. Look at the scrap value for normal loss. Look at the scrap value for normal loss. We say abnormal loss has 100. So now let's see what we do here. Normally, we have our direct material, direct labor, production overhead. And we said scrap value, we are going to less scrap value. And then we got this as before. So it reduces the total production costs. Now expected, we are going to divide by the 1,800 expected. It means 2,400 as we did in the second example. Now look at the costing. Finished outputs, we are going to use 2.4 to cost the 1,700 good outputs. We will get this. Abnormal loss, we are still going to use our 2.4 to multiply by 100 to get 240. Now your normal loss, you see, it is 180 as we got before. So let's see how the process account is going to look like. Once again, this debit side is the same. Now, because there is a recoverable value, normal loss has something. Abnormal loss is still the same figure here, and we still use the good output cost to multiply by the abnormal loss because we don't expect it to happen. And look at the output, the good output, we use the 2.4 to multiply. So this is the process X account. Now look at how we account for losses. Look at the abnormal loss account. From the process X account, we find out that this 240 was credited here. Process account is going to be debited here. Fine. Now, when it is debited here, abnormal loss. Now, scrap account, 90 naira. So 0.9, you know, this scrap account, this 0.9 naira is the value of normal loss that you recover it. So now, this abnormal loss, you have now recovered 90 naira out of it. When you recover 90 naira out of it, it means that income statement 150 naira is what is going to be written off in the income statement. Now, if you go to the scrap account, process X account, process X abnormal account, normal loss. From the normal loss, you got this 180 here from the normal loss, which is taken to the scrap account. Then the abnormal loss, see this 90 naira, we bring them here. So it means that you lost 300 units. You are scrapping 300 units, sorry, which are the losses. And look at the scrap value. Now, this means that this is the cash. So if you look at it critically, 90 naira was what you recovered plus your 180. That means 270 naira were what you recovered. This is what you recovered. Okay, so far so good. We have taken up to abnormal loss. We're not going to take abnormal gain today. So we are going to look at only abnormal loss. We'll look at abnormal loss. We look at scrap account. We've looked at what do we call it? We looked at the good account. We look at the recovery, when there's recoverable value and when there's no recoverable value. This process costing is very wide and interesting. So I want you to look at all we've done today. Look at it critically. Read through the other materials so that when we come to the next class on Monday, we will finish this part, abnormal gain, and then go into part 2 if need be. Any question you have, feel free to ask me personally or through the WhatsApp group. For some time now, I've not been getting questions from you, so I want to assume that everything is fine with you. But please don't fail to send questions when you have issues. Thank you so much for making today's class very interesting. I'm happy you came in time. We didn't lose any time, although I expected a normal loss of time as usual. But today, you've done well. I wish I would get abnormal gain in time in your next class. Thank you so much, and we'll see you on Monday. Have a nice day.
Hello, Prof.
Yes, sir.
Yeah, you'll be the one to end the class. The host was transferred to you.
Oh, okay, no problem. Let me end the class now. I'm even
Okay.
seeing end here. Thank you.